We've been positive for Europe since September 23.
But are you still?
We are. We are still positive Europe. We've been positive Europe because we could see some underlying fundamental improvements in the economy which the market was sort of missing out on. The reason why we're continuing to see that is a number of factors. Number one, because we believe that this Make Europe Great Again is real. It is happening.
Despite all the fragmentation that you have in Europe.
Despite the fragmentation that we're having in Europe, we believe that this is a true moment where the Europeans, finally, the European politicians and policymakers realized that the transatlantic relationship is no longer the same as it was after post-World War II. And although the tensions were during Trump 1, they did not improve under Biden administration. So the Europeans are taking more responsibility, more action. Admittedly, the sort of the theoretical 5% target in terms of NATO is not going to happen over the next few years. It's going to happen over a few decades, and it's a 3.5, 1.5. But even so, the actual investments in infrastructure, in productivity, in technology, in manufacturing is all going to be supportive, number one. Number two, we're also seeing from some of our clients, and what we're hearing, is that large asset owners and sovereign wealth funds are looking to invest, put some money into Europe. So we like Europe on the top-down perspective. We also like the fact that from an inflation point of view, again, it's done better than we thought, and maybe partly because of the tariffs, partly because of the strong euro, partly because of the strong euro in all terms, and inflation could potentially go even lower, helping the ECB to cut interest rates. So we're seeing constructive valuations, fundamentals in Europe.
So what do you buy exactly? You've highlighted infrastructure, you've highlighted some defense, but give us some concrete positions.
Yeah, we do not discuss, we do not invest in them, we do not invest. We do not advise in individual equities. We bring exactly into names. So we prefer the more diversified exposure in terms of Europe. Finance obviously will be a key beneficiary of that, but it's not just about the equities, it's also about the bonds, it's also about the currencies. So we've been positive euro since March, 107.87. We've been positive in bonds, and some of our clients have been saying, well, with all of this fiscal expansionary policy, why would you be positive bonds?
I'm asking the same question in my head.
Which is a very fair question. Number one, because the Bundesbank is there. And the Bundesbank, if the Germans trust the Bundesbank more than they trust anyone. So the Bundesbank is there, good old Buba is there, and they will make sure that the Germans don't spend like the Greeks did. So we are going to be seeing the prudency in terms of the economic fiscal expansionary policy. Secondly, I think we are also, again, I don't believe in the end of the US exceptionalism. I don't believe that's happening. But diversifying a little bit away from US treasuries to something like German bonds for large asset owners is not unreasonable. So we could potentially see some interest in bonds as another area to park some money on the fixed income side. And going back again, in terms of the inflation story, if inflation is as well behaved as it has, the real yield may not be as attractive for bonds as it is for treasuries, but it's a good diversifier.